So you are contributing to your 401k plan at work every paycheck, and I pray that your company is also contributing to your 401k plan. Um, and you probably have a plethora of mutual funds you can choose from. So, what now? Do you know what you're supposed to do from here? Hello, my name is Dr. Jerry Sonamo. I have a PhD in financial planning and I'm a registered investment advisor. And I would like to explain a 401k strategy I guarantee you have never heard before. I call it my Portfolio Papa 401k strategy. First, let's talk about some of the problems when you decide what strategy you're going to use in your 401k plan. The first is life cycle funds. A lot of people choose life cycle funds or age-dated funds or retirement-dated funds, target-dated funds. They're all the same thing. And the problem is the traditional approach to diversification in these funds. Now, this is an oversimplification, but I need you to get to understand the idea. Generally, these funds choose put some money in funds that may make money in a bull market, and put some of the money in funds that will not lose as much money in a bear market. This is typically the strategy used by life cycle funds or periodic restructuring of funds or robo advisors. Another one is diversification. A lot of people think they're diversifying by putting 20% of the funds into a large cap fund, and 20% of the funds into a mid cap fund, and 20% of the funds into a small cap fund, and 20% of the funds into a foreign fund, and 20% of the funds into bonds. The only problem with that is you have 80% in equities, and they're all losing money in a bear market. We think you can do better than that. Let me explain our Portfolio Papa 401k strategy. Bear markets always follow bull markets, and we have been a protracted bull market for some time now. The first thing you want to do is move your entire account balance, old money, to somewhere safe. You will periodically move some or all of your old money at those turning points that would avoid a bear market. Step 1. Sweep your total current account balance, old money, to a 100% money market fund or stable money fund or a bond fund. This will then become home base. You will want to start your future ongoing contributions into more aggressive funds, since Portfolio Papa is a proponent of not leaving all your eggs in one basket. In our registered investment advisor practice, we will tell our clients to allocate new money into 2 funds as follows. Step 2, start your future ongoing contributions to 50% into some sort of high volatile fund like a small cap growth fund, and 50% into some sort of foreign fund or emerging market fund. Here's a quote: "The only thing new in the world is the history you don't know." That's from Harry S. Truman, 1960. And trading is no different. It is imperative that you study some history of each of the funds in your 401k portfolio. 401k portfolio managers like to introduce new funds to excite their fund participants, but they're totally useless to us because you can't chart a recurring cycle algorithm that's worth anything in a fund that's only 18 months or so old. When we help our clients choose which funds in a portfolio to use, we look at funds that are at least 10 years old. Please note, during bear markets, the more volatile funds will fall precipitously, thus allowing your regular ongoing contributions to be buying more and more shares at bargain basement prices until such time as the market turns. This concept is called dollar cost averaging. Let me explain by showing you an example. Let's say you have $300 to invest and the current share price is $33 per share and you believe we're in a bear market. If you buy all the shares for $300 in month 1 at $33 a share, you will only be able to buy 9 shares. Instead, you decide to put $100 each month into one of the funds in your portfolio for 3 months. In month 1, the share price is $33, so you can buy 3 shares with your $100. Please allow me $1 of literary license here. In month 2, the fund share price is $25, so you can buy 4 additional shares. Finally, in month 3, the share price is $20, so you can buy 5 shares. In total, you purchase 12 shares over the 3 months for an average price of approximately $25 each. $300 divided by 12 shares equals $25 average share price. Let's say the market rebounds the next month to $26 per share. At $26 per share, had you invested all $300 in a share price of $33, you would still have a loss. The share price of that fund must rebound to $34 a share or rally up 70% from $20 per share before you can make a profit. The problem is, in a bear market rebound, it may never get to $34 a share. It could hit $26 and turn back to a bear market. But because you use dollar cost averaging, the investment has to only rebound $1 more than half of your average price for you to make a profit. So 12 shares times $26 a share equals $300. That's $312. Divided by $300 that you invested equals a +4 return on your investment, or ROI as we like to call it. The point no one seems to understand: if you make 4% in 4 months, your bank CD or annuity would have to be paying an annualized rate of 12% for you to make the same amount of return on investment over the same period of time. Remember, bank CDs and annuities never make capital gains for you. They only make capital gains for insurance companies and banks. Back to Portfolio Papa 401k strategy. Sometime in the future, when a buying opportunity arises, you will want to move some or all of home base into a fund that tracks the S&P 500 during bull markets. In our registered investment advisory practice, we send our clients an email telling them to allocate some of their home base old money into the bull market fund we have determined ahead of time that we would use among our clients' 401k portfolio of funds. Step 3, move some percent of home base old money into a S&P 500 index fund or large cap fund. You will want to choose a fund that tracks the S&P 500 average. When the market turns back to a bear market, you will want to complete step 1 again, sweeping all the money from all of your accounts back to home base, thus avoiding the bear market decline. So step 4, 100% money market or stable money fund or a bond fund. Now, doesn't our Portfolio Papa 401k strategy make more sense than letting your entire account balance ride the stock market roller coaster? But be in the market in bull markets and out of the market in bear markets. Instead of losing money, you can be earning interest. Quote, well then, you should have put my money on deposit with the bankers, so that when I returned, I would have received it back with interest. Matthew 25:27. Of course, if your employer is not matching or contributing to your 401k plan, you should not be in a 401k plan at all. All you are doing is building up an enormous tax bill that will have to be paid in retirement. You can reach us at www.portfoliopapa.com/contact or by calling 714-437-9955. I hope you've enjoyed the presentation and that if you need assistance, you will give us a call. God bless and keep you and yours forever and ever.